the best of Money Matters.
Market View on Money FM 89.3.
You're tuning into Money FM 89.3, and it's now time for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares dipped today, tracking losses across the region. So the Straits Times Index was down 0.33% at 3,869 points at about 12:45 p.m. Singapore time, and that is with a value turnover of some 633 million Sing dollars seen in the broader market. Now, as we shared with you earlier, the STI ended relatively flat, down 0.06% at 3,880 points. In terms of value turnover, we're looking at 1.35 billion Sing dollars. Gainers trailed losers 178 versus 288. Top advances for today, we've got for you Singtel, Asus and ST Engineering. And top decliners, we've got here GMXUSD, SGX and HBL. Now, speaking of companies to watch, we have Singtel, one of the top advances, because the telco giant returned to the black with a net profit of 2.8 billion Sing dollars for its second half ended March. And that is compared with a net loss of 1.3 billion Sing dollars seen in the previous corresponding period. Elsewhere, from G7 finance leaders trying to downplay disputes over US President Donald Trump's tariffs to Bitcoin surpassing 110,000 US dollars for the first time to head towards another record high. We've got more international headlines in focus. Also on deck, how the Singapore government is keeping the country's economic growth forecast for 2025 at 0% to 2%. Now, lots to unpack today, and joining me on the line is Terence Wong, CEO of Azure Capital. Terence, welcome back.
Hello, Tian Tian. No, welcome back for you. I've always been here. No, I've been here. I've been in Singapore for a while. You, on the other hand, have been traveling.
Yeah, I've been traveling. I hope to do a little bit more this year, hopefully. But let's start with the Singapore stock market as usual. Terence, how did the STI fare today? Any surprises when we look at the biggest movers?
As you mentioned earlier on, that it was not exactly a great day for Asian markets today, after what transpired yesterday over at the US, which has a potential to further enlarge the US. They're talking about the potential for the enlargement of the US deficit at a time when the US assets are not widely perceived, to be safe and risk-free anymore. This is really a huge dampener. But for the STI, at the start of the session, the first half wasn't exactly that great, but it managed to claw itself back to almost, next to nothing, no change for the day. I think it was down like 1.2%. I'm looking down the list right now. It doesn't seem like there's anything that really stands out. No big surprises, no major movers amongst some of the bigger stocks over the STI.
But let's talk about telco giant Singtel, Terence, because Singtel returned to the black with a net profit of 2.8 billion Sing dollars for the second half ended March, compared with a net loss of 1.3 billion Sing dollars seen in the previous corresponding period. And aside from that, the group also authorized its first share buyback program of up to 2 billion Sing dollars as part of its capital management strategy, in addition to incorporating its wholly owned subsidiaries in Singapore like your Singtel International Digital Services and also IDS Cloud. How far are the latest numbers in line with your expectations? What is your take on the outlook for Singtel in the near term?
Well, the previous corresponding period that we're looking at recorded a net loss due to non-cash impairment charges on goodwill. That amounted to 1.47 billion. Not exactly like chump change, right? But fortunately for this half, there was really no one-off impairments. Singtel posted a net profit of $2.8 billion, like you mentioned, and closely matching our forecast. I think we're talking about $2.76 billion. And this, I think, really reinforces our positive outlook and supports our view that, Singtel remains pretty much on an upward trajectory. We've been talking about it. I think we've mentioned it, a couple of times over the past year. And the stock has done fairly well. Fourth quarter numbers, the underlying earnings was up 3% to 600 million. That's due to lower than expected contributions from regional associates. But the dividends per share of 10 cents in the second half, that exceeds our expectations, and that brings the full year dividends to 17 cents. And this includes the core dividend of 12.3 cents, and that actually implies a very, very robust 82% payout ratio. Management of course, what's important for companies is forward-looking statements, right? Management has guided for core EBIT growth in the high single digits. That's supported by $200 million in cost savings. That exceeds the current consensus forecast of 5% growth, and this positive momentum is expected to continue, and I think that it's going to be boosted by increased asset recycling. The target right now is $9 billion. That's up from $6 billion. There's also a share buyback program of $2 billion. I think that investors should cheer to that. That's another compelling catalyst for investors. Traditionally for these companies like Singtel, these utility-like stocks, they actually perform well during periods of heightened uncertainty. And guess what? Right now we are talking about really heightened uncertainty. So I think the stars are kind of aligned for Singtel, despite it, seeing quite big jump. We're talking about 15-20% over the past year. I think that there's still value to the stock.
Okay, now from Singtel, Terence, let's talk about Capital Land Ascot Trust, because the hospitality player announced yesterday that it priced its 260 million Sing dollars in perpetual securities at 4.2%. The issuance is expected to be on or around 28th of May next week. What do you make of the move?
Well, 4.2% coupon, I think that's attractive for the issuer, especially when compared to recent perp securities pricing of about 5%. For instance, ESR issued 5.75% just in March. The issuance is expected to be used primarily to pay down its debt from their results released late last month. We note that gearing has been flirting with 40%. I think it's 39.999%. And that's driven by M&A activity and capex related to asset enhancement initiatives. But we believe gearing is likely to trend lower as proceeds from upcoming divestments and even this, and of course this issuance will be channeled towards debt repayment. The REIT remains very focused on portfolio reconstitution with a preference for long-stay assets such as Japanese rental housing and student accommodation in very, very safe jurisdictions like UK, Australia, and maybe not as safe, as well as the US. So maybe the last one is not exactly the safest, but they are in very mature economies, or they are gunning for growth in the very, very mature economies, and the pipeline also includes accretive acquisitions.
Okay. Terence, I do want to stay in Singapore because the Singapore government is keeping the country's economic growth forecast for 2025 at between 0% and 2%, though it said that external demand outlook for the rest of the year has improved slightly. Now, if we look at the latest GDP numbers, the economy grew 3.9% on a yearly basis in Q1 of 2025, slightly higher than an earlier estimate of 3.8% made in April, but weaker than this 5% growth in the fourth quarter of 2024. How far are the latest numbers in line with your expectations? And as always, does the GDP outlook ahead provide us with any clues on how SGX listed counters will likely perform going forward?
Well, we don't have any explicit forecast, but we do think a slowdown and not a recession should occur in the second half. The US-China, the 90-day truce, that which is and now will extend into August, will boost front-loading and trade volume in the second quarter and moving into the third quarter. Currently, based on data from BCA and our discussion with local construction companies, you're seeing a bit of do you call it construction boom? Well, there is definitely a hike in activity, as well as falling interest rates as reflected in SORA, and fiscal support provided by government. All these will help mitigate the blow from the tariff shocks and trade war. From fund flows, we see Singapore benefiting from safe haven flows, which will help support financial and real estate activities. When we're talking about the tariffs and all, of course, our tariffs seem low at 10%, that's compared to other countries. Of course, it is not as good as what we had before, which was 0, right? But Deputy Prime Minister Gan Kim Yong has indicated that negotiations are ongoing for tariff exemptions on key sectors such as pharmaceuticals. And preferential access to advanced chips, so we can see how that really pans out. So on GDP and the market, I think GDP actually drives corporate earnings. So this is important, given that our benchmark STI is very, very exposed to the banks, the property guys, particularly the banks, because they account for 50+% of our total, the total weightage of it. So the likes of DBS, UOB, all of them will be affected by the GDP to a certain extent. Then more so UOB than say DBS, right? And also Singapore's trade-dependent economy means that SGX-listed stocks, but especially those in export-oriented sectors like manufacturing and shipping, they are vulnerable to global trade disruptions. And also on that topic, a stronger Sing dollar, often a result of economic stability, can hurt export competitiveness, impacting companies that are very, very export-driven, like say SATS or Keppel. So it does affect us. But of course, if you are talking about STI, there's also and moving into the third quarter, there's also a catalyst, which is that $5 billion equity market development program, right? That should boost liquidity, notwithstanding the somewhat challenging environment out in the very near term.
Yeah, and if you're just tuning in, we're in conversation with Terence Wong, CEO at Azure Capital. Well, Terence, further away, let's talk about how finance leaders from the G7 industrialized democracies, they sought to downplay disputes over US President Donald Trump's tariffs and to find some common ground to keep the forum viable as they met in the Canadian Rocky Mountains. Now, they appear to try to reach an agreement on joint communique, largely covering non-tariff issues, and the discussions included support for Ukraine, the threat from non-market economic policies of countries including China, and combating financial crimes and drug trafficking. What do you make of this? I mean, is this more beneficial for everyone than discussing tariffs given what happened in 2018's meeting?
Sorry, do you say more beneficial or not beneficial?
More beneficial.
More beneficial. Yeah, in a way, yes. The G7 finance ministers' current focus, like you mentioned, all those non-tariff issues like support for Ukraine, then the bogeyman China whacking them, right, tackling financial crimes. All these are very, very safe zones for to discuss. It can be seen as a strategic pivot to maintain cohesion in the face of potentially divisive tariff disputes, particularly those associated with those Trump-era trade policies. And it's hard to forget the chaos in 2018, like you mentioned. That was horrible. I mean, that year, Trump's tariffs on steel and aluminum triggered retaliatory actions, and his withdrawal from the joint communique fractured the cohesive, consensus building and G7, right? And by avoiding the topic of tariffs this time around, I think G7 is just trying to play it very, very safe. And I think that this probably would be the strategy going forward.
Okay. Now, since we're talking about Trump, we must talk about Bitcoin, because Bitcoin surpassed $110,000 for the first time to head towards another record high, with traders increasingly bullish on the prospects of the cryptocurrency. Now, a few things weighing on prices. One is wave of optimism buoying Bitcoin after the advancement of a key stablecoin bill in the U.S. Senate, with surging demand from MicroStrategy and a growing list of digital asset hoarders. Not to mention how Trump is holding this meme coin dinner right outside Washington. So your thoughts on the matter?
I say amazing, because not too long ago, not too long ago, Bitcoin was just on its downward path, hitting 85,000 and all, and you thought that it's gonna come off, and then before you know it, within a few blinks, we are now hitting record levels, right?
Yeah.
110,000. I think that reflects a potent mix of market dynamics and regulatory tailwinds. Advancement of this stablecoin bill in the U.S. Senate is, I think, a big deal. It shows there's a clearer regulations, and that could legitimize crypto further. Drawing in institutional players, which it has really done. They have been skittish about the legal gray zones. This isn't just about speculation; it's a signal the market interprets as risk reduction, and that's boosting confidence. You mentioned at the start of the program, MicroStrategy.
Yeah.
They have this massive $50 billion Bitcoin hoard. I think it's 250,000 Bitcoins and counting. So this creates a supply squeeze. The strategy is just buying Bitcoin. It sounds easy, but I think there's a method to the madness, right? So as more entities actually jump on the bandwagon, hedge funds, corporates, and they mimic this playbook of buying Bitcoin, hoarding it, crimping the supply, right? Then, and when more demand comes in, this outpace the available coins. So that will have implications for Bitcoin. And I think it already has. That's why we are looking at record levels. But let's not get carried away. The rallies, fueled by optimism. But it's also very vulnerable to sharp corrections, as we have seen in over the past 2-3 years. We have seen it go up, come up, go down violently. So I think investors do need to be cautious about this, right? Yeah, but who am I to say? I've been wrong about Bitcoin before. Right? just a disclaimer.
Okay. Now, finally, Terence, U.S. President Donald Trump's massive tax and spending bill that cleared an important procedural hurdle in the Republican-controlled House of Representatives on Wednesday, U.S. time, that is. So what would this mean for U.S. Treasuries and hence the appeal of U.S. equities right now? Is it the time to buy up U.S. equities then?
Well, I think there are grounds to be cautious. One combination of rising treasury yields, Moody's downgrade, and a projected debt increase signals heightened fiscal risk. Investors are demanding for higher yields to hold treasuries, which could increase the borrowing cost across the economy. So that's something that I think investors have to look out for. Trump's tariffs. Number two, Trump's tariffs already implemented or proposed, are expected to reduce economic output and raise consumer prices, despite the administration saying no such thing, right? But it is, and I think that the retailers are already feeling the bite, and we are talking about from small to the super large ones like Walmart, right? And number three, the bill's passage is not guaranteed, as it faces hurdles in both the Senate and opposition from both moderate and hardline Republicans. And I think in terms of market sentiment, we have seen in recent times that U.S. assets have been sold off due to fiscal concerns, and this could also be one of those cases. So I think that investors should be cautious. They should be nimble.
Thanks so much for the insights as always. That was Terence Wong, CEO at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Thanks, Tian Tian.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.